Let me ask you something. If your business partner died yesterday, unexpectedly, no warning, what happens to the ownership stake in your company? Does it go to their spouse, their kids? Does it go back to you? And more importantly, do you have the money to buy them out at a fair market value right now? If you're not sure, you probably need to revisit your buy-sell agreement, and you're definitely not alone. I'm Matt Losanno with Cinder Wealth. Today, we're talking about buy-sell agreements, what they are, how they're funded, where they go wrong, and what you can do to make sure yours actually works. A buy-sell agreement is a legally binding document between business owners that lays out what happens if an owner dies, becomes disabled, wants to sell, and various other triggering events. Think of it like a prenuptial agreement for business partners. Without one, you have a few real problems. A deceased owner's shares may go to their heirs, who have no interest in running the business. You could end up with a hostile co-owner you never agreed to work with. The business might be forced into a rush sale at the worst possible time. With a well-structured buy-sell, you create clarity. The remaining owners know they can buy out the departing owner's stake. Departing owner's family gets fair market value in cash. The business continues without disruption. But here's where most people go wrong. A buy-sell agreement is only as good as its funding. If you have a buy-sell that says surviving partners will purchase the deceased partner's shares at fair market value, but there's no money set aside to do that, you're stuck. If your business qualifies, maybe you can take out a loan. If not, you may end up with a new unintended partner. The most common way to fund a buy-sell is with life insurance. But how that life insurance is structured makes an enormous difference. There are two main ways to fund a buy-sell with life insurance. A cross-purchase agreement, which each owner buys a life insurance policies on every other owner. When someone dies, the surviving owners use the insurance proceeds to buy out the deceased owner's shares directly. This is clean for tax purposes. The surviving owner gets a step up in their cost basis, which is valuable if they eventually sell the business. The downside? If you have more than 2 or 3 owners, you end up with a lot of policies. 3 owners means 6 policies. 4 means 12. Entity purchase agreement, sometimes called a stock redemption. The business owns the insurance policies on each owner, receives the proceeds, and uses that money to buy back the deceased owner's shares. This is simpler to manage, especially with more owners, but it doesn't give surviving owners the same tax basis step up. Now, there's a third option we often use when the traditional cross-purchase arrangement isn't practical, a special purpose LLC. The special purpose LLC owns the policies, keeping the insurance outside of each owner's estate while giving each person the flexibility to take their own policy with them if the business is ever dissolved. Now, here's something every business owner with a buy-sell needs to understand. In 2024, the U.S. Supreme Court decided a case called Connolly versus the United States, and it has major implications. Here's what happened. A business had a buy-sell agreement funded with life insurance, structured as an entity purchase. When one of the owners died, the company received the insurance proceeds and used them to buy back his shares, exactly as designed. But the IRS argued that those insurance proceeds, the ones used to buy the shares, should be included in the owner's taxable estate, even though the family never actually received that money. The Supreme Court ended up agreeing with the IRS. So here's the trap. If your buy-sell is structured as an entity purchase and the insurance isn't handled correctly, your estate could be taxed on the proceeds of the life insurance policy when they are included in the business value. How do you protect against this? First, make sure the agreement includes a clear valuation formula that's updated regularly, typically every 12 to 24 months. Second, work with your advisor, your CPA, and attorney to make sure the policy titling and agreement language are all coordinated. And then third, consider whether a cross-purchase structure or a special purpose LLC structure might be more appropriate for your situation. I've reviewed agreements that could cost an owner's family millions just due to poor policy structure and titling or missing language. The attorney did their job, the insurance agent did theirs, but nobody coordinated. That's the gap. Let me give you the most common mistakes I see with buy-sell agreements. Mistake number 1, having one, but never updating it. Your business was worth $2 million when you signed it. Now it's worth $10 million. If your insurance coverage didn't keep pace, there's a massive gap. Mistake number 2, no funding at all. Some business owners have the legal document, but no other insurance or funding mechanism. That's the equivalent of having a fire escape plan, but no fire extinguisher. Mistake number 3, policy structure that doesn't match the need. This is what Connolly versus US addressed. The insurance structure caused the proceeds to be included in the business value and the value of the estate. Mistake number 4, never showing it to your financial advisor. Your attorney drafted it, your insurance agent sold you the policy, but if your financial advisor hasn't seen both, nobody's making sure they work together. Mistake number 5, using term insurance for a long-term need. term insurance expires. If your buy-sell is funded with a 20-year term policy and you're still running the business at year 21, you're unprotected. Here's the bottom line. A buy-sell agreement is one of the most important documents you can have as a business owner. It protects you, your partners, and more importantly, your family from chaos when something unexpected happens, but only if it's properly funded. Only if the policy tightly matches the legal language, only if it's updated as your business grows, and only if your CPA, attorney, and financial advisor are all looking at it together. If you haven't reviewed yours in the last 2 years, or if your business has grown significantly since you signed it, it's worth pulling it out and taking another look. If you need some help, feel free to reach out. Subscribe for more content on tax planning, exit strategies, and wealth coordination for business owners. Thank you for watching.